Welcome to another episode of Erickson TV. Curtis here with Lauren. Hey, Lauren.
Hey, everybody.
Hey, Lauren. You've been doing some interesting research about how people become successful at different ventures in their life, including investing. What did you find out?
Yeah, a new study has come out, and I'm going to skip some of the math and go straight to the conclusion of the study. But basically what they found in the study is that when they created mathematical models that resembled how the real world actually is, they found out that the most successful people, the Bill Gates, the Steve Jobs, the Oprah Winfreys of the world, might not be the people you want to imitate. Because in many cases, their success was due to either circumstantial factors that will never be repeated, or that their success was due to taking extraordinary gambles that worked out for them, but which did not work out for the 90% of people who took similar extraordinary gambles.
So then, I always hear about like small business owners or investors are saying, okay, investors say I'm going to imitate what Warren Buffett, or a small business says, hey, I'm going to imitate Bill Gates.
Yeah, exactly.
So who should they model then?
According to the study, the interesting thing was that even though the most successful people were not the most skilled, there was what they called the second tier of successful people. These were people who have been successful for a long time, and even though they're never the most successful, they very consistently did well. These were the people who probably had the most skill, and had the most skill that would apply to other situations other than their own. In other words, if you're a small business owner, the people you want to imitate are not Bill Gates, because he had circumstances that will never be similar to yours, and whoever takes the kind of gambles that are as successful as the kind that Bill Gates took, it'll be in a completely different circumstance, a completely different arena. It'll be a whole different gamble. Who you want to imitate is, and I don't know enough about software to know this, but you know, whoever is in that second tier of developers, those are the people who are consistently successful and probably have consistent skill.
Okay, and then from an investor point of view, I think we could probably then say, well, then we would want to maybe try to get in the upper tier of investing by following a strategy that has shown consistency over a long period of time.
Right. When I read the study wasn't exactly about investing. When I read the study, of course, one of the first things that clicked for me is, actually, this is like investing. You know, the diversified passive investing strategy will, over 10 years, beat about 70% of actively managed strategies. After 20 years, about 80%, actually more than 80%, because the worst strategies fall out of the study. They try to hide them and pretend they never happened. But you know, over a long period of time, a passive diversified strategy can be expected to beat the overwhelming majority of its more active competitors. But you know, if you diversify, it means you don't put all your eggs in one basket. Which means that over any given time period, at least one of the things you invested in has to do better than your diversified strategy. Something, But the problem is that the only way you could have picked that is by totally gambling. Well, if you want to gamble, that's fine, but recognize that gambling has a negative expected return. So, you know, most of the people who gamble are not going to succeed.
Yeah, so I guess in conclusion, for every Bill Gates, there's literally thousands of people that have gambled and failed. And for every hot investment sector, there's maybe a person or a manager that hit that, but there's thousands that missed it. So, okay, it makes a lot of sense. Well, thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.
See you next time.